Welcome to Housing Developments. I'm Paul Lopez, not with our fearless leader, Jim Tobin. He's out on the road, but this kind of gives us a little bit of time to space out and kind of open and spread our wings a little bit. I've got two great economists, Danielle Hale from Realtor.com. Welcome. And I've got our very own Rob Dietz.
Yeah, good to join you.
Absolutely. Yeah. Okay, but before we start, though, I need to, and Danielle, I want to know if this is how you work with your people as well. So the way we get Rob on the podcast is that he does not really say, hey, do you want me on the podcast? Reagan Hansford gets this kind of weird email from Rob saying, I'm not going to be traveling October 1st and 2nd. That's it, right? So then we have to decipher whether or not that means that Rob is available, and then usually he is. But
it's a tease.
It is a tease, right? Because you can't throw yourself out there, right? You're too big for that. So.
There we go.
Well, welcome to you both. Before I start, big thanks to our sponsor, LG Pro Builder. Let's build a good life together.
That's right. Yeah.
That's right. So that's important. So I want to kind of work. The theme here is going to be the good, the bad, and the ugly. But we're going to Quentin Tarantino it. We're going to go backwards, right?
Backwards.
So we're going to go ugly to bad,
right.
And then I always like to finish on the good. Okay.
Right.
Obviously, the ugly right now is the shutdown that started right now today.
Yeah.
I want to hear from both of you in regards to what that means on the macro level, and then what does it mean for the industry. So, Rob, why don't I start with you in terms of the macro level, in terms of what are we looking at here?
On the macro level, I mean, we've gone through government shutdowns before. This one's likely to last longer. We kind of know the items that are affected from a housing policy perspective. So things like flood insurance, certain programs that are dependent on the government acting. But I think it just kind of contributes to the uncertainty in the marketplace right now. I think this one's likely to go on longer.
Right. Doesn't seem like anybody's willing to go to the table, at least.
No, and there's real policy divides between sort of how to bring this one to a conclusion. Thus far, the bond market seems to be handling it well. That doesn't really play into your ugly theme, but that's been kind of a theme of the overall economy thus far, that the risk factors haven't had as big an effect on the economy. So we're just going to have to wait and see, but wait and see is going to be a little bit more difficult. I guess let's hand over to the industry side when there are other things the government does that we aren't going to get.
Right. Like we won't have data production starting with Friday's job report. And we're at a very critical moment right now. The Fed has just started recalibrating policy. They wanted to be data dependent, but right now they're flying blind. They don't have the data, and it seems unlikely that we're going to have that data anytime soon. I mean, fortunately, there are private data providers, so we do have some shading around the edges. But unfortunately, we're missing that gold standard government data to really give us the key stats that the Fed would use to make decisions. So that's unfortunate.
And the ADP report, that's kind of that private data report, showed a job loss this month. So I don't think it changes what the Fed's going to do, that they're kind of locked into the idea of some additional easing, but it just increases the uncertainty. It makes things hard to measure. So, economists, we hate this, right?
Yeah, sure.
And it creates other kinds of disruptions that'll make it difficult for businesses and home buyers.
Well, I mean, especially if you look at, I think the New York Times did a good job in terms of what departments are most affected. I mean, the heavy hitters, EPA, right? Commerce, labor, HUD. Those are all 70% or above of their workforce are going to be affected, either furloughed or there's a possibility of layoffs. I mean, that's going to affect, just our members being able to do the business, right?
Yeah. So getting the permits necessary and the approvals from EPA. Now, there are certain programs, and NAHB now had a great blog post listing things that are kind of on cruise control. So like some of the multifamily financing programs, but there could be delays. Some of these things could be deferred. So it just increases that macro uncertainty. And the shame of it is in recent months, with the Fed beginning to ease, some of that uncertainty has begun to be reduced. And that's what we really need to see kind of an improvement in home buyers willing to actually purchase homes.
Now, you guys both said that the Fed is not on cruise control, but they'll be doing their thing. But in terms of rate reductions, the uncertainty mounting, and we're going to talk about tariffs in a few seconds here, but do you guys see any kind of impact? And what are you guys predicting in terms of one rate cut, two rate cuts, and at what basis points?
Well, they've got two more meetings between now and the end of the year. The Fed is kind of split, actually. If you look at the dot plot and where people expect the rates to end up at the end of the year. There's a wide range of viewpoints. So, a good chunk of people are expecting every meeting rate cuts. That would be 2 more 25 basis points cuts between now and the end of the year. And that's what the market has largely priced in. But there's a not insignificant contingent that thinks maybe we won't need additional rate cuts. And so that's why I think missing that data right now is going to make those discussions really difficult for that deciding body.
Sure.
And this is one of those forecast items. I mean, we revise the forecast all the time. As you all
What? An
know.
economist revised the forecast?
That's exactly right. But, for the last 6 or 9 months, we've had basically, we thought at the end of the year, 2 rate cuts.
Right.
So we got one in September. We still think we're guaranteed one more, whether it's November or December. But as Danielle indicated, there's this kind of growing divide among the voting members of the Federal Open Market Committee on whether it's going to be 3. And then, of course, you have newly installed Governor Moran, who has said on his dot plot projection 5 rate cuts before the end of the calendar year. Now, the risk is, I think the industry would love to see more easing, but the risk is if you move too fast, the bond market might say, they've moved away from the 2% inflation target, and then you could get the opposite effect where short-term rates are going down, but the inflation premium goes up, and that drives long-term interest rates higher. So they got to do it in a managed, orderly process, and as you indicated, it's hard to do when you're flying blind.
Right. So let's talk about tariffs now, because that's the other thing that kind of hit us this week. 10% on lumber and timber, right? It's lower than we thought, right? Which kind of means that they're kind of listening to us and such. But then we start targeting into cabinets, and by the end of the year, 50% higher, furniture, that kind of thing. Talk to us about the impact there.
Yeah, it's been kind of interesting as I've traveled in recent weeks. I've been in Alabama, Texas, Kentucky, going to Alaska next week. The feedback on the road is, the lumber tariff at 10% across the board tariff is not great. Smaller than expected. It does stack on top of the existing duty, which had already moved from like 14% to 35%. So, we'll be watching the lumber market in terms of pricing. It has the potential to add several $1,000s to the price of a typical newly built home. Where I've heard more concern is in remodeling. Right. So you mentioned, with bathroom vanities, upholstered furniture, kitchen cabinets. Yeah. We could see some significant increases in the price of that. So it'll be interesting to watch whether that affects remodeling demand.
Is that something that you track as well, Danielle?
It's not really, but I do think this type of expenditure has been a little bit more common with people locked into their homes. Mm-hmm. So remodeling has been a way that you can sort of adjust your home to fit your needs without giving up your low mortgage rate. And so if that gets more expensive, it'll be interesting to see. It's still probably a better option for most people than trying to reset their mortgage rate. Right. But obviously when things get more expensive, people are less inclined.
Right. Does all of this affect, your guys' let's talk about 2025. Yeah. We're entering the final quarter. Right. What do you guys see in terms of any kind of effects in regards to the tariffs, the shutdown, anything like that, or just the overall economy? Yeah,
we kind of right down the middle on the tariff effect. There were a lot of sort of exaggerated impacts that were expected to come from the tariffs that haven't materialized. But some of those impacts were sort of taking the Liberation Day tariff rates at face value. Those have not gone into effect as we've kind of moved in this deal making. So,
our members are absorbing at least some of the costs in terms of rising tariffs.
Yeah, right? When we surveyed builders, it's been kind of interesting. 40% of builders say we haven't seen any kind of cost effect. Now, 60% have, and when you kind of work that, it's about $11,000. But the result from a macro perspective is that the economy continues to grow. The labor market has certainly slowed down because we have smaller inflow of immigration this year. But GDP growth is going to be just under 2% for 2025. That's good. It's not great. It's certainly not the risk that I think some economists were talking about, like 80% recession risk this year. That's not happening. Right. So I think the market is doing a good job of absorbing it, but the question is whether these are short-term measures that will give way to long-term pressures in 26. So hopefully we keep the deals going. I think most economists would agree fewer tariffs are better, but looking for fair trade as a political outcome as well.
Yeah, and I think it's easier for consumers and businesses to absorb this early on when the labor market has been pretty strong. So I think we'll see they start to, I think, have more drag maybe as we move into 2026.
Has 2025 been kind of a disappointment in terms of output in regards to the industry?
Yeah, for single-family home building, the expectation is single-family housing starts are going to be down 5 to 10%. We've got, I think, 7% decline on the table right now. So, and when we were doing our forecasts at the start of the year, we had flat single-family home building for 2025. So the combination of a wait-and-see economy, home buyers sitting on their hands, interest rates, at least for the first part of the year, hanging closer to 7%, and then all the cost factors and other challenges for the builders meant that this was a year of taking a breather. Right. Now, when you look at it in kind of the last 5 years, it's the third year of decline in the last 4. 2024 was kind of the up year, but the expectation is 2026 is going to be better. There's a lot of buyers on the sidelines. And with the Fed easing and mortgage rates now below 6.5%, we're going to get an incremental increase in demand.
You're nodding your head. You agree?
Yeah, I agree. We were, I think, even more optimistic about 2025. So it has been disappointing relative to our forecast.
Right.
But I do think, we've been waiting a long time for mortgage rates to kind of get back to that low 6% range. And we're finally there. We have been here before. We were about here roughly last year, and then had some setbacks with rates moving higher. But I do think that this time we're finally at a point where it looks like the Fed is going to ease. The tighter policy isn't necessary anymore, and so we will see mortgage rates kind of revive buyer interest.
Very nice. Let's start moving into the good, right?
Okay.
Danielle, you guys recently set out a report. NAHB has been partnering with Realtor.com. To talk about the Let America Build, right, which is obviously important for us.
Absolutely.
You came out with a study. There are markets out there that are still hot, right, for lack of a better term. They're still growing. What were some of the patterns that you saw? Let's go there, and then we can go into the deeper markets.
Specifics. Yeah, so big picture, the South is where we see a lot of building, and there's also a lot of buyer interest in new construction in the South. So in general, the South, a lot of the markets are in the South. And then we have a couple of markets, one each actually, in the West, the Midwest, and the Northeast. So
let me guess. Idaho in the West.
Yes. Yes.
Yeah, the top job performer by far.
Everyone's going to Idaho.
Absolutely, yeah.
Sorry, go ahead.
No, you're right. So Boise City in Idaho is what we see. It is our number 2 market. Fayetteville, Arkansas was our number 1 market. And this study looked at the availability of new construction, the cost of new construction relative to existing construction. So are the new homes that are being built much larger or largely similar to the existing construction that's already in the market.
Right.
We also took a look at the riskiness from a climate perspective of those properties.
Oh, that's
because
interesting.
We do have climate risk data that's available on Realtor.com. It's provided by First Street. And so we matched up those the risk profile and compared it to the existing homes in the area because obviously, the heat risk and hurricane risk is higher for everyone in Houston than it is in, say, Oklahoma City.
We just need insurance markets to reflect the lower risk for the construction.
Yeah, right.
That's something I hear from builders all the time.
That's a separate episode.
Yeah, that's right.
But anyway, so we included that, and then we also looked at hotness. So how in demand new construction is relative to other homes in the area. So Fayetteville was number 1. Boise was number 2. A lot of college towns actually are on the list because we've got markets like Austin, Texas, Madison, Wisconsin, and Raleigh, Cary, North Carolina. So.
And that's because there's a baked-in need for housing there, right?
Yeah, I think so. You have a dynamic local market. You've got a lot of highly qualified entry-level laborers, and so a lot of companies are locating to those areas and recognizing that. And then you've also got university health systems and the faculty that are teaching there. So there's a lot of jobs in those markets, and so the markets reflect that.
Is it baby boomers too? I'm going to retire next to a university that has some more culture kind of thing?
I mean, those markets also tend to score very well on those retirement destinations.
Yeah.
So that's probably playing a role as well.
Okay, excellent. You can find that on Realtor.com if anyone's interested, right?
Yeah, Realtor.com/research. And then we also have Realtor.com/Let America Build that focuses around the campaign. The research is the research and data section of the site.
Absolutely. So definitely stay tuned for that.
Yeah,
Check it out.
Yeah.
Okay, so let's put you guys a little bit in the hot seat here, right? I'm actually a little bit of a forecast, right? First round of questions. We've already talked a little bit about the markets improving for 2026, right?
Yeah.
Any particular areas that we need to focus on? Anything that you guys are looking at in terms of I'm keeping an eye out on X to kind of give us a good gauge in terms of what we're looking at in terms of housing.
Yeah, it actually kind of builds off of the college town environment. Is one of the areas where we're seeing some momentum is the Midwest. Single-family home building is actually up in the Midwest in 2025, and I think that momentum will continue in 2026. And it's really a story of housing affordability, job growth, potential for some uptick in manufacturing, the AI data center investment, which has often been concentrated in the West and areas like where we are now in D.C. If you're looking to make future investments, maybe you want a little colder temperature environment for energy maintenance, and that's going to help workforce development. This has been something I've talked about, it feels like now for a decade, but townhouse construction continues to be a bright spot. I think that will continue in 2026. Townhouses are about 18% of single-family starts, and whether it's infill development, inner suburb development, converting an old shopping mall into an urban village, you see that trend really kind of picking up, and it's a great way to add housing units on a smaller amount of dirt, and that's what we need to do as an industry. So we're watching that, and then some of the markets that have been down. So like in Austin, Texas is a good example. It scores well on Danielle's list. The inventory has been up, pricing's been down, but the job and the population growth is just so good.
Right.
So watching a rebound in 2026 on some of these high population growth, job growth markets, I think is key.
Danielle, what are you looking at?
Yeah, it's funny that you mentioned the Midwest, because I was also thinking, like, our new construction report usually shows that there's a lot of potential opportunity in the Midwest. And one of the questions I have asked my new construction researchers, why aren't builders building there? I mean, they are, but I think there's still more opportunity.
Yeah, and if you look at markets like Columbus, Indianapolis, St. Louis, Kansas City, I mean, there are great potential opportunities. I mean, we've got team members right now. They're headed out to Northeast Ohio and Wisconsin to give talks, and I think that's an area where the land markets are going to see some improvement in demand because of the potential.
Yeah.
Okay, so that's what you guys are looking at. As laymen, as industry professionals, what should our listeners be kind of keeping an eye on for the next few months?
The Federal Reserve and the 10-year Treasury rate. I get that question a lot, and I always tell builders, the one number I check every single day is where the 10-year Treasury rate is. So it's right at 4.1% right now. If that number could come down to 4, would we be looking at mortgage rates getting closer to 6? And I think that most economists kind of say if we could get mortgage rates down to 5.95 or 5.99.
Sure. Yeah, there's that magic number.
There's a bit of a kind of a disproportionate amount of demand that would come in, and so it's not just the Fed easing, but if fiscal policy can establish some guardrails and show some restraint on government spending, that'll be good for long-term rates. And then 2026 could be a year where some of those buyers in the wait-and-see economy will come back into the market.
Excellent.
Yeah, I would say the one sort of bright spot for builders, if we don't see rates come down, is that we've seen builders offer incentives. And so those mortgage rate buydowns make new construction particularly attractive when rates are still high. I'm sure they're not a favorite thing to have to offer
on the balance sheet, right?
But it does. We see it in our data that there's more interest, and there is a pretty sizable differential, and so that is a way that builders can really stand out and differentiate in this market.
And you had some great data on Realtor.com in terms of maps of where buy downs and other kinds of incentives were being used using your database, right?
Yeah, that's right. So we took a look at and this is what's advertised, which might be a subset of what's actually offered if you go talk to the builder. But among promotions that were advertised, we looked at things like cash at closing, mortgage rate buydowns, appliance packages, all those sorts of things. And 2/3 of what is being offered right now is mortgage buydowns. So builders know what works and they're using it. And so that is, I guess, the silver lining. If it takes mortgage rates longer to come down, that does make new construction a lot more attractive. And that's something I talk about when I'm speaking to realtor or other real estate agents. I talk about, if you don't have a new construction strategy, you really need to think about having one, because it is a good alternative that your buyers might not have considered in this market, but especially with mortgage rates that are still high, it needs to be part of your strategy.
And this is the part of the theme that Jim and I are always talking about. The builders are doing everything they can to keep building and to keep adding to that supply chain, right?
That's right.
Whether it's incentives, whether it's mortgage buydowns, whatever it is, packaging in terms of upgrading kitchen suites or whatever. because the demand's there, right? It's just, and that's the most frustrating part of our industry right now.
And policymakers recognize it. I mean, the Federal Reserve Chairman Powell has talked about the fact that, to get to the Fed's 2% inflation target, we need additional attainable supply. That will bring shelter inflation down. And I think the Trump administration's listening. We talked about it with respect to the lumber tariff. Yep. Lumber tariff was a little bit smaller than I think we expected. And let's see if we get some regulatory improvements, whether it's federal level, state and local level. Policymakers have been talking about it a lot more. I think there's a recognition as we head to the 2026 elections that the cost of housing is going to be key. So we could be getting some help in 2026 from the Fed, from state and local governments, from the federal government, and all of that would suggest that some of that uncertainty that held the market back in 25 gets relaxed. Right. We'll see an increase in demand in 2026.
Yeah, I was going to say from a policy perspective, it's not just about, I think, swaying the decision makers. I think a lot of decision makers are well aware of the challenges. And the industry is certainly well aware of the challenges. Like, that's one of the things that we tried to do with that Let America Build campaign is bring that message to the broader consuming public. Because I think everybody understands that home prices are high and that housing is expensive. But what seems so obvious to us on how to fix it is not necessarily obvious to consumers. So that campaign is really around raising awareness among consumers and building the the groundswell of public support to make it easier for policymakers to make the decisions that we think will benefit the industry and the general public and help make housing more affordable.
No, absolutely. We talked a little bit about 26. You guys are both here. I'm going to do a shameless plug for the International Builder Show. You guys are both going to be there. Obviously, you're going to be there. You're expected, but it's great that you're back again.
I am back again.
Danielle's been a great friend of the show, and we'll be doing the Outlook session with Ali Wolf from Zonda again.
Probably the most popular session in that building that week.
Standing room only. It is our guys love data. So,
absolutely. So February 17th to the 19th. If you're a member, you're still eligible for a free Expo Pass. You should go to buildershow.com to get all the latest deals. I think that's it. Anything else? You guys
just see all the members on the road. We've got just tons of events coming up. Like I said, I got Alaska coming up, and just kind of listening to people get their view on what the market's going to look like in 2026.
Absolutely. Danielle, anything? Any shameless plug that you want to do?
Well, we did talk about the realtor.com/research.
No problem. Yeah.
Lots of data available there, free to download. Help yourself.
Check it out.
Absolutely. Once again, a big thank you for our sponsor, LG Pro Builder. Let's build a good life together. Thank you very much. This was kind of cool.
Yeah, this is great. Yeah.
All right. With that, I am Paul Lopez with the two economists here. Thanks a lot, and see you next week.